This is Justin Pulitzer. This is my weekend review video for Sunday, October 16th, 2016. It is being filmed on the 15th, Saturday, though. We'll start out with a brief recap of the Fed, go into the 7 market keys, do the major market indices, some of the momentum stocks, and if there's time, I'll finish up some of the stocks I didn't get to on Periscope that people asked about. Anyhow, with regard to the Fed, the probability of them hiking in November is very slim. It's below 10%. However, the December probability is quite high. It's been vacillating roughly between like 59, 60%, and 64%. So the street seems to think that the Fed is going to go in December. I have discussed that all year. I thought that the risk of the Fed hiking interest rates would be in December. So we'll see. The minutes weren't conclusive. They talk about the GDP risk being to the downside, the global risk being to the downside, although moderating a bit because of Brexit not being as bad as everyone had thought, although lately there's been a little bit of issues in China. They talked about the inflation risk being to the downside, and they said that they saw the employment risk being to the upside, with room for the employment to grow without any wage pressure, however. We know that since then we've had a unemployment number that was a fairly large miss, and some of the data, it's been spotty at best in my view. The GDP expectations for them from 2016 through 2019 are unchanged, and they say that the economic outlook was balanced. They talked about the decision to hike in September or not was a close call. I think that that's just prepping the market for potential moves in December. Like I said, I don't think December is necessarily a done deal, but as of right now, I'm thinking that they might hike, and I believe that the November minutes, I didn't mention this in Periscope, but I am now, the November minutes I think are going to be the tell. When they come out, I will read them thoroughly and let everybody know what I think about them. And that's what I have to say about it. As far as Gump would say, that's all I have to say about that. So the VIX has been fairly tame given the, I guess, level of pessimism that's in the market. I ran a poll this week. I ran a couple. The last couple of polls have come up pretty bearish, actually. The one I ran, the last one, I asked which way the next 5 points in SPY were going to be. It was split roughly around 34%, thinking up and down. Unsure but leaning up was only 11%, and unsure but leaning down was 21%. So I guess the pessimism is probably the best thing the market might have going for it right now. There's definitely no euphoria. But there are some concerning things that are taking place in the market, and I will cover them here. Anyhow, the VIX has got basically up to the upper end of the kind of okay range. I drew in a downtrend here. We had a little bit of time we spent above it, and we basically got into there. We closed just below the 200 MA here. When the VIX gets to this lower end of the range, you could bet that there's usually going to be some kind of a pop-up in volatility. People buy protection or favor the idea of outright shorts. You can see we are starting to make some higher lows, however. We haven't started making higher highs, but I will say this. The risk of a breakout, meaning a breakout of range, is probably more to the upside than it is here to the downside. So if we do take out these kind of last highs here in the 17s, we could see a move up to the 20s, 21s. Wouldn't surprise me if there's a bit more of a down flush in the market, but I think we're in one of these periods where we have this kind of vacillation of volatility. I don't necessarily know that we're in a new uptrend yet, but we definitely are in a vacillation mode. I mean, you can see this spent a lot of time doing these before we got, the bigger kind of corrections, so I can't necessarily say when that's going to come, but it may be coming. Anyhow, the dollar. This is what I've discussed being the biggest threat that I see to the market currently, and we have now broken out of the kind of the downtrend. It's really just been in a more lateral range. I might even think about expanding where I drew these lines, but we did spend some time under here. We're starting to make some higher lows, and now making some higher highs. So the trend in the dollar has now moved from down to more neutralizing. I had said that this was a potential head and shoulders pattern, and a break over the 200 MA would be trouble, and it is, actually. I don't necessarily know that we're just going to completely, go to the moon with the dollar, but the risk to the dollar now, I believe, would be to the upside. The good news is we're coming from kind of the range low and coming up into the range high, so there could be more of a move in the dollar, but I don't think we're going to kind of just like sail to the, I don't think we're going to do one of these moves necessarily. So what does that mean? This is not good for S&P earnings. Companies that do business overseas, this is going to be a factor again in their earnings reports. I'll tell you this, there's sort of a circular reference with regard to the dollar. The more the dollar rises, the more traders and Wall Street types are going to think the likelihood of the Fed going increases. However, the more the dollar rises, the less likely the Fed would go because they don't want to exacerbate the move in the dollar. The Fed kind of wants a Goldilocks scenario where they can kind of hike interest rates and do kind of the, the kind of Hippocratic oath like doctors, first thing is to do no harm. I wouldn't have necessarily said that was the case with the Fed in the 90s under Greenspan, but under the Bernanke-Yellen era, it seems to me that they're, I don't want to say afraid of their own shadows, but I don't think they know the economy is weak, and I don't think they want the recession that rate hikes could cause to be hung on their, around their necks, so to speak. The economy really is not very strong. We are, like I said, the economic data has been coming in weak. Yellen even on Friday gave a speech where she talked about running a hot economy, or I forget what the exact term was, a more robust economy. Anyway, the economy is not hot. We can't reach our inflation targets. The GDP levels are very low. Stan Fisher was even mentioning that they're frustrated with the fact that we have this slow, stagnant growth, and the purpose of rate hikes is really to cool a overheating economy or economy that has inflation. And by their own metrics, they aren't meeting any of those targets. The truth is they shouldn't be talking about rate hikes in December. They should be really talking about more accommodation. And I've, in the past, suggested that they might want to consider increasing the inflation target, similar to what is going on in Japan. So a couple of 3 press conferences ago, I want to say, the one where I mentioned the come to Jesus moment with Yellen, she mentioned symmetry, meaning that she would allow more inflation because we've been under the 2% for so long that she might allow the inflation number to be over 2% for a while. That makes a lot of sense to me because just because you hit your 2% inflation target, they haven't been able to reach it for years, so why not let it kind of balance out a little bit? I don't really see the harm in them letting the economy kind of do better before they, choke it off. I mean, you're choking off, pretty stagnant growth. So that's my take on the, I think that this is her new way of introducing the term symmetry, but she's calling it with, letting the economy run hot. I guess she's getting a little less academic and more into the common vernacular. Anyhow, we are in a channel. It seems to me that the risk is probably going to be somewhere to the upper end of the channel or even this range high with a potential overshoot. I do think that this area will be some reference resistance and is probably a good opportunity to sell or try right or right out shorts just because we came up from the bottom. But the dollar could stay stubbornly strong for a little time, and that could be troubling for the market. The bonds are right on kind of the level that they really need to hold. There's a longer term channel. There's a uptrend within the channel, which is this line, and then kind of a channel within the channel. So we're on the channel low here. Anything below the 200 MA to me is a little susceptible. There are some reference areas here, though. This had been a 61.8 test of this range. It bounced, came down, kind of held a little bit again, but now we're below it. So this area, and you can see I drew in I drew in this oval a while back. This really is where we need to hold, and anything below the 200 to me does risk a move in this sort of bigger range to a move either back to the 50% fib or the more pronounced uptrend, or even 61.8, which is really where this consolidation took place before this move. So if the Fed is, if there's fear of the Fed, we could even come back down into these 125. So I like Friday's range. Anything above this to me here would be kind of a look below. You can see it stopped on the 200 and then reversed. So anything above Friday's high, which was 132.95, I like long, as this would be a look below and fail, and we'd probably come back up pretty quickly to the 135s. But anything below this 131.59-ish area, I'm thinking we could see 129s and maybe even 126s, 125s. So that's my take on TLT. The ideal scenario, obviously, for that trade would be for it to keep dumping ahead of the Fed, and then, maybe it would be a fade off of that. Something else that I know the Fed watches, and that's the kind of the high-yield corporate market. This is far from panic mode. When we get crash mode, it sort of would look more like this. This was, of course, because of oil. There was a lot of fear about oil companies being overextended with leverage. I think for the most part they've been able to hedge off a lot of that as oil has risen. So I don't know if we're in the same predicament that we were in before. There had been some bankruptcies, but we're roughly holding this 50 MA. You can see we did break trend here a little bit. We rode the backside of it, and now it's kind of coming down a little bit. So this is something to keep an eye on. If we start getting in one of these trending modes, that will not go over well. However, the good news for that is that will probably stave off the Fed. The 200 MA here, you can see, was a big point of contention for a while. Broke above, kind of rechecked again. So if we start losing the 50, then I'm going to think the 100 and like this sort of 85 area. But if that gets lost, there could be a move back down to the 200 MA. The thing I do like about this, though, is that the 200 MA is clearly no longer in a downtrend. It is now in a young uptrend. So I don't really know that we're going to be in a credit type of crisis, but this could cause a little bit of I often affectionately use the term shake and bake. You can see we got into the edge of the volume distribution. So it wouldn't surprise me to see it pull back into the last node, sort of like hit resistance, and then pulling back into some other reference areas. So that's my kind of take on HYG. If this, kind of just stays sideways, kind of okay. But if we start making, lower lows and off of lower highs, then, the market isn't going to be a happy camper. The aforementioned oil is behaving actually fairly well. You had the rig count came up a bit. You had a fairly bearish inventory number. They were expecting a drawdown, and there was like this really big build. However, it is holding around the kind of breakout area from this range that I've identified. It's not the peaks. I kind of used some lower peaks just for some various reasons. This one was factored in as well. This is looking like a little bit of an inverse head and shoulders. However, we did move up from quite a bit here. I think it's just spending some time digesting here at the edge of the range. I drew a new uptrend channel. We are definitely not in this downtrend. We broke out. Wouldn't surprise me to see this check back, however, to like 46s. If we lose 49s, then I'm thinking for like the 50 MA and 100 MA will be in play. So it's sort of this bar here to me was important. 49.15 was the low. The high was 51.60. So anything over 51.60, I'm thinking 54s to 56s. Anything below this 49.15, I'm thinking a retest of the 50 and the 100, wherever that may be at the time. So keep it simple, stupid with oil. But we all know algorithmic trading has been keyed to a few things lately. It's been sort of this unholy troika or witch's brew of the dollar, the bonds, and oil. So, the other day, Thursday, when the market was in kind of tumble mode, oil really came to the rescue. It had that big move down and then kind of came up, and I think that's really what the algo is keyed on. So We're into kind of double toppy area. If this kind of goes sideways for a while, the probability of them being taken to the upside greatly increases. We do know that the OPEC meeting is happening soon, so I'm thinking that they might want to try and squeeze some shorts ahead of that meeting. I don't know if they're going to do real production cuts or not, but the commodity is acting fairly decently, actually. XLE is in a bit of a kind of a accumulation channel. That's what this looks like to me. It spent a lot of time going down. It came back up into some reference resistance, and it's in a bit of an accumulation channel. The breakdown was up here around the 72s, so that's been no surprise. You could see the edge of this volume distribution. That's been a bit of a point of contention for a while. So in the short term, you could use this like 50, 100 MA as key levels. If you lose there, I think we'll just rotate down to the channel low, but I'm more in the buy the dip mode with this than I am in kind of sell the rally. I like buying, the channel low. It's held several times. This one didn't even get down here. You have a 200 MA that'll probably be roughly on the channel low if we get down to there. That would be the edge of this volume distribution. This, by the way, this study here, this blue is volume profile. You can add that in if you like. It helps me identify sort of where the supply is, where there's not a lot of the gaps between the supply and where high volume nodes are. So I kind of like just playing the range, selling the upper end of it and then buying the lower end of it. We haven't had a 200 MA test in a while. I would be all over that in size if we got it, and ideally the scenario would be, straight down, but as long as we hold these 50 and 100, there's really not that much to discuss here. Exxon, kind of a similar pattern. They have earnings coming up. This did have a really large reversal ahead of here. I had actually sold some puts into this zone below 83s. I was looking to put on a whole size position around the 80-81 area and trend. We never got there. We do have earnings coming up. So this was a bit of a look above and fail. We came down, held the 220 roughly, and now just kind of chopping around. So if you lose this swing low here, the 85.43, then I think we're going to kind of come back down and retest these lows and maybe even the channel low. But anything above this range here, these sort of 87s, I'm going to start favoring more back to the upside. You can see the 50 is right around here. You have the 100 right above. That's been a little bit of resistance. So I think we're kind of caught between the moon and New York City, the 200 and the 100, and look for a definitive break either over the 100 as a long or below the 200 as a short. We'll keep it kind of simple, stupid, right? China, gotta have your China. They are also sort of trying to repair. It broke kind of the uptrend within the up channel and pulling back a bit. You can see the 100 MA is roughly on the channel low. I would be interested in buying a channel low at sort of a high volume node. Below the 50 kind of keeps that in play. Back above the 50 to me would be... actually, hold on, let me zoom in here a little bit more. This sort of, I want to say it's an island reversal low, but we kind of came back up to the 50. So I'll say this, above the 50, I like long for move to the channel high. Below the 50, I either want to be flat or more bearish for a move to the 100. So that's sort of my shtick. I've been looking for a move back up here to the 40, 41-ish area. But again, a kind of an accumulation channel. The 200 is sort of flattening, and I like long against 100 MA, channel low for a BTD if this comes down, which means buy the dip, or this could have been kind of like a look below the 50 and fail, and we come back up. So the 50 MA is really key. You're going to find that to be a very common theme in this video, by the way. BABA had a 50 MA hold. Let me zoom in a little more here. You can see, by the way, with BABA, we got up into like kind of the key level, moved above the channel high. Now we're back into the testing into the channel. So I really think the 50 is key. If you lose the 50, in my view, I think you could come back down into like these 90s, these like lower 90 area where the old support was, where this kind of volume profile picks up. They do have their earnings coming up, so this could be the setup for a shake and bake. So I'll keep it simple, stupid. 50 MA plus, I like it more long. Below the 50 MA and below this 99 level, you can see 98.45, 99. These were the last lows. The breakout here was 98.35. So this area really needs to hold. If not, I think we're going to be kissing the canvas here into the 93s and 91s. So that's my my take on the BABA. IBB looking rather fuggles. Yeah, I make up language once in a while, but got to keep it interesting. We're coming into the 61.8 of the range, below the 200. You can see this kind of stopped a little bit shy, so this is going to be, in my view, if you're bullish in IBB, a RORO area. I'm a little cautious, though, because you have a lower low now. You broke kind of this point of contention. A failure there could even rotate it significantly lower to the lower end of the range, but if you want for a trade, the 263.79-ish area, in my view, would be a RORO. I will not be taking it just because I think we're getting kind of... I shouldn't say I won't take it. I might be considerate to take it if there was like a hammer low that it, like if it proves to me it holds, like it comes down, there's like some kind of hammer low, I would play against that, or maybe sell some out, near dated, very near dated out of the money puts, maybe at like the 78.6, the 253s, just because we've come down so far so fast. But you can see there's like a lot of these 100% retracements. Yeah, I mean, below the 275s and the 271s to me is a little bit more vulnerable. Below the 200 MA to me is a little bit more vulnerable. So I would either like this now back over the 200 MA for this being like kind of a look below and fail, or really RORO here. Or another way to play it is with put ratios, like you buy these, sell 2 times out of the money here in like the same week or the next week expiration. Gilead looks kind of cruddy. It's just kind of hanging around this regression line that I've drawn. A 50% fib of the entire move and a 1.618 Fibonacci extension. Let me get rid of this here. I think it was of this range down to here was roughly 69. So this I am actually starting to get a little bit interested in. The big move here started all the way from 63s. So somewhere in the 60s, I'm going to be getting interested. I'll probably, as we come into this 69, probably sell 63 puts. So that's my view. I mean, look, the stock is basically going to be been cut in half down there. So down there, it starts to interest me. Big overview topping pattern, but this has been coming down so much. I mean, it's way in oversold territory. Yeah, on a flush down, I would be interested. The ideal scenario here, of course, would be for it to come down strong ahead of earnings and then set up long to play the earnings, maybe sell the puts because they'll still be juiced. SPY is in a interesting setup here. This has been in a up channel for a long time. There's no real meaningful excess here, but you had some look aboves and fails, and you're kind of been consolidating for a while. I really hate how this looks, this chart. Let me zoom in a little more here. Sorry, just playing around with this. Maybe nope, that looks even worse. Anyway, let me just do it this way. Kind of a mini, I don't even want to call this a head and shoulders, but it's like a mini range. And you can see this kind of broke down and has just been kind of chopping. The channel low has roughly held here, kind of screwing around that channel low. On Thursday, you had a look below and fail. These lows here were very key, and this was a look below and fail. Then we kind of had a gap up on Friday, which just kind of fizzled and faded all day. It closed kind of still okay, but there's nothing conclusive. So what I'll say is this, is the more time we spend under the 100 MA, the more vulnerable. First of all, look where this is, the resistance has been. no sustainable moves above the 50 MA. These has been, let me go into a more modern day chart here. Maybe manual would do this. Sorry, this is a really important area, and I want to really capture it well. This is a disaster. Something happened with one of the chart updates. Oh, this is okay. Something happened with the chart update where it's kind of been playing games with the range, or I should say with the way to draw the charts. Anyway, anything below the 50 MA, you can see this was kind of a gap below. It stalled here, couldn't sustain here. This was a look above and fail. This was a test that failed. So anything below the 50 MA to me is still vulnerable. Anything below the 100 MA is still more vulnerable. Anything below the 100, you got to be targeting, in my view, the 200 MA, which comes in around 206.65. But with the caveat of this, that this was a look below and fail, that we broke the range and there wasn't acceptance. The sellers weren't there. We had overnight inventory that was fully net short, and buyers stepped in. You have to keep in mind that these levels that are kind of between us here and the 200 MA are big. I mean, we've spent a ton of time consolidating at this like 210, 211 area for a long time. You can see here there was a lot of points of contention here. This was the Brexit high, pre-Brexit high was 210.87, and we came down like into the 211s, and there was responsive buy. This does not surprise me. I do think if there's a move down, it's going to be kind of, I don't know if I'm going to say cascading, but I would think it would be a stubborn grinding move. I've said that the way to target it would be to kind of double the range from this low to this high. I might have to use this low now, but for now I'm going to keep this low, and that would take you roughly to the 205s, 206s. If you kind of take the Brexit move and you project it down, that's into the 205s. You have the 61.8 there of the range. There was an old reference support there as well that I have from a high. The Yellen breakout from her come to Jesus moment was 205.25. This is sort of the end range of where I think the market would hold. I mean, there's always a possibility it overshoots to the 203s to fill the gap, but this 205 area is really where I think that the tape will find support and hold itself. So that's kind of like, I think, we're getting late in the year. That's probably, in my view, famous last words here. It could really just be a complete disaster, but this would be, in my view, the kind of maximum downside that I'm looking for at the moment. So yeah, I'm going to just keep it really, really simple here. This range, these 2-day ranges, the low here was 211.21. If you lose this again, I even said if you want to be aggressive, you can use this body here. I wish I could zoom in a little bit better here. The body here was 212. This is showing 14, but I think it was around 16 or 17 when I did it on the other video. So somewhere in there, anything above this sort of body high, which is basically where we closed. Look at the close here, was 213.01. Friday's close was 213.12. Is that right? Yeah, all right. I thought it was a little lower. So anything this body, above it, I want to, I guess, be a little bit more constructive to the upside. Below it, I'm thinking more short. So that is going to be my, that's all really I have to say about that. If you start taking, like if we were to have a move above Friday's high, I think we'd have to be targeting the 50 MA again. So this 2-day range is really key. If you're more bearish, and I know from my survey people are, if you lose this body, that's a right or right out short, and then a move below the low, which was 211.21, would be an add to the short. So you'd be starting here and then adding below there, and probably looking to cover a little down here and then into the 200 MA, which could coincide with the 61.8 and a channel low. Ideally, that would all coincide, and then you could kind of reverse it and set it up long. Back above Friday's high, in my view, would be a long to the move to the 50 MA, and given the look below and fail nature of this, this could really, really get going back to the upside. So that 2-day range to me is really key. IWM got my target here. You can see I had the oval drawn in. Roughly the channel low and the 100 MA, you can see this roughly coincides with this is basically a double bottom. So if there were to be like a gap below on Monday, I would say you can use the high of day of that gap as a stop and play for a kind of a gap and go, given the fact that this is kind of bookending two swing highs. So anything in my view below 119.88-ish, this is the low here was 120.11. So anything below these kind of double lows in the 100 MA, I would think we'd easily see the 117.37 and potentially a move even as low as the 200 MA. So these 2 days, in my view, are really key. Back above the high here would be a successful double bottom, and I would think that we would at least come back up and test the 50 and the 20, which would be around the 128s, 123s. This was the old high, so anything really below here starts getting a little bit more iffy. There is some reference levels, so I don't know if there's going to be a complete easy collapse, but this is those two lows are really important in my view. The fly in the ointment for the bears are the Qs. This is still above the old reference high. This is almost looking like a secure low, just below the 50 MA. So again, the 2-day range is key. Above 118.08, 118.05. I'm thinking a move back up into the 119s, but a break below the 115.94 and the 115.75. I think we would retest the 100 MA pretty quickly. The reference low here was in the 113s, so we would, I think, see the 113s quickly and maybe even articulate as far as the 111s. That was really where this kind of breakout happened. You can see this gap. It wasn't really this. I guess this, I can't really say this was a gap, but you had this like kind of stutter step here, and then it went. So you have a 50% fib just below there, a trend. This area to me, the 110s, 111, like the high 110s to low 111s would be the target point. If you if you break this, the trade would be short. Cover some at the 100. You could even, if you're bullish there, reverse and go right or right out long. But I would think that this would probably have like some kind of move to the 100, a little bit of a bounce up here where you could kind of reshort the balance of it. Like if, let's say you're short here, let's say you put in 100% of your trade, cover 50% here, let it bounce, add back on, and then play for the move there. Or, that's actually, I think, the way I would actually play it. So that's how I'm thinking here. But anything back up above this 10-day and 20-day, the high a day from Friday, it's probably going to be a party back to the upside. The Apple. So I started closing some short puts. This has moved a lot. We're getting close to my end target here of the 119.75. There's a channel high up closer into the 120s. So they were just killed. The puts I had on were just murdered. My ideal scenario always with Apple is the shake and bake. I would love a move back down to the 50 MA, which you can see is roughly running along the channel low, for a buy. If this continues to run ahead of the earnings, then I would continue to book profits, and any gap on that up would probably be an opportunity to sell or short. So I'm hoping, my fingers are crossed for one of these type of moves, the shake and bake, where you come down hard and then you have the move kind of up on the earnings. Like this wasn't earnings. This was the earnings. Like you moved up, few days down to see the channel low, and then it was the gap and go. So this would be the ideal scenario in my view for a long for Apple. Facebook is just kind of chopping around. 50 MA was very key here. Below the 128.33 to me is a little bit more iffy. Kind of had a look above trend. Again, the 1.618 that failed. They also have the earnings. I would love, again, the same kind of scenario where this came down to the channel low. I don't know if we're going to get that, but if there is some nasty move this week ahead of the earnings, the 100 MA would probably coincide with the channel low and this range low, and I would be thinking more long than short for a bounce. I will say this, that there is going to have that Snapchat IPO coming public, and there'll probably be some risk of people pulling some money out of Facebook to buy Snapchat. But in the bigger picture, I think that the Snapchat IPO is going to show just how cheap Instagram is, And yeah, I mean, I think that was one of the great bargains of all time. Twitter ran up, got into some resistance, and has collapsed as the deal prospects of a buyout are, I don't want to say completely washed away, but a lot of the companies that have come forward that seem to be the buyers, the Googles and the Salesforces, have basically kind of ruled it out. It seems to me that the stock ran up on that, and if you're going to be a buyer, you would deny it so that the price would come down. Not for nothing. I don't know if we're going to see that, but there's a lot of put activity in the 11s and 12s out in November. Huge open interest. So a lot of people seem to think that Twitter is going to come back and retest the old all-time low. There are some speed bumps in between there, the 15s. I do think that this kind of volume range here between the 1569 and the 1619 is a right or right out area. But yeah, below the 200, I mean, below, all of this kind of consolidation. And you could say that Twitter overshot here. This was where it was before the speculation came. But I think the hope has always been for Twitter that there would be a buyer, and that seems to be, fading. They're going to have to do it on their own. So I've said for a while, I think this is going to be dead money for a while. They're not really moving very quickly. You could get lucky with a takeout, but I'm thinking that it's right or right out in this area. If that fails, it really could revisit the 12s. Amazon, it got into my sell range, 833.91. It overshot a little to the 847s. I had said that if you did a measured move, let me go back a little longer, 2-year daily, that if you measured this move here, which is a 411-point run, if you projected that off this would roughly have taken you up to the 885. And I said anywhere between the 833 and 885 was the point to sell, that we're getting a little late in the move. 50 MA has been key. The ideal scenario here, again, would be a pullback. I would love to see this thing pull back ahead of the earnings to kind of get back in. I don't think that this thing is going to really just completely collapse until you would, at the very least, in my view, see some type of a lower high. Just the way that this thing has been bought up. So, yeah, that's what I'm thinking. I know people are very bullish on this. This pullback after that big run was 200 points. So, I mean, that would roughly take you down to the trend. I mean, I don't know if we're going to see that, but that ahead of the fourth quarter would be really something special to BTD into. I'd love to sell some out of the money puts. Anyway, a little bit more immediate. That was just sort of my brainstorming. We're kind of running into some issues with this progression line that I drew in here. I'm thinking I would be an interested buyer somewhere if this does dump somewhere between the 50 and the 100 MA for a right or right out play, at the very least for a day trade. Netflix, this was, it's funny, I had this stock long and I got stopped out. It was getting close to my target, and those guys from Deutsche Bank came out, and I had said that if this kind of failed, we'd see the 50. We did. It rallied back up. We're making some higher lows with some higher highs, so the pattern is starting to shift. They do have earnings ahead of us, so I'm thinking that if the earnings are good, we're probably going to either see the 110 to 115 area. If they're bad, we're probably going to snap the triangle and retest the range low around the kind of the 85 area. 93s, 92s was were a key level. If this were to continue selling off ahead of the number into there, I might be interested in selling some out of the money puttage down kind of closer to these lows, the gap fill. So yeah, that's my thinking. If we hold if you're long, 50 MA is the key. That's below is definitely a stop out, in my view. Google is behaving rather well, consolidating. Remember, this worked all the way from a look below and fail. This is a true island reversal. We didn't even get the channel low. Consolidating here. I'm thinking that Google wants to see the 1.618 up at 895. I would love for this to do a shake and bake, but it just seems content on chopping. I don't think that this is going to resolve ahead of the print. but I am thinking that this could likely go higher. TASR got into some important reference lows, channel low, this old 21s. I said that this was an area to kind of buy the dips. It seems to be working. I think that somewhere between these 1990s and these 21s is the BTD area. This move down was based on them losing a contract in New York, and that was not good for them. They basically, the competitor undercut them by half. I don't think that competitor can make money on that, but you know, this area is very key. I mean, if this gets lost, you could theoretically see the 17s. I do think longer term that the market for TASR is getting larger. So I like the, this could be considered an island reversal here off the 200 and a successful test of this low. So you could use Friday's range. Anything below 22.33 is a little bit more iffy. Above the 23.28 to me is probably a move back up to the 25s. So that is the TASR. PayPal, one I've liked for a while. Got into some reference resistance. I sold this at 41.10. I don't remember where that was. I think it was this day. It came back down, got a little higher. I have been selling some puts into the pullbacks. I actually did it here. I like selling 37s and 38 puts. I think that this area will be some reference support. And I like the idea that it's coming down ahead of the earnings. That, to me, is a better setup than if it was to rally strongly. Gap was a similar trade as the TASR. I had actually been long this and sold a while back. It went still higher. It came back down to this gap fill, and I actually bought stock. It promptly turned around very nicely. I think it actually was this day. It went up and then came a little lower, but I kind of held, and it ran up a couple of days into the earnings, and then I had this beautiful gap and go, kind of a professional looking gap. With regard to the, this Zoom is just so annoying. I'm thinking that this is going to, this was just some stuff I drew in. I'm thinking that this range, this low here can be a stop, this 26.19-ish area. The close on this day was 26.25. So anything above this range, I think, could move higher to the channel high. There is an old reference high roughly here around 30 half-ish, 30.49. It could do something like grind its way higher. So I'm still long, I'm holding. If we lose this low, I'll probably stop out of some of the position. And if we lose the 25.70, I'd probably be out of it all. But yeah, I like the gap and go over the 50, the multiple days of consolidation. Anything that breaks out of here should continue. So gap, I'm still long the gap. Some of these stocks I didn't cover in Periscope. I'm going to cover them quickly. Skyworks, I don't love. I do like that this broke out of the pattern. I do like that it's making higher lows and higher highs. I don't like that it's rallying ahead of the earnings, though. A pullback ahead would be better. If this continue, the ideal scenario would be is if this does gap up on earnings into the backside of the old uptrend line and the 61.8 of this entire move, it could be a good area for right or right out short into like these 90, 92s. Yeah, I mean, if this keeps rallying, I would not be wanting to continue to be long, particularly ahead of the number, considering look where it's rallied from. But a pullback into like the 200 MA, you can see that was some resistance here, and then moves below became unsustainable. I'd be a buy the dipper if this were to like gap down or ahead of the number, preferably get down to like this 100 and 200 period MA. I'd be interested in a right or right out. You can see this kind of flash crash low was roughly around 70, 80. So somewhere in there, I think could probably be a good setup. Someone asked me about Delta Airlines, not one I follow very often, but look where the real breakdown took place from, the 50 MA. Moves above were unsustainable. Now it is supporting. So 50 MA, it's a little far away from there, but above the 50, above the 100, it could move to easily to the 200 or even the channel low. So yeah, I like it as long as the 50 MA kind of holds. I don't know if I'd be loving the idea of chasing it, but yeah, this trend. I mean, we're in a kind of falling triangle-ish pattern. So I guess buy the low of the triangle and maybe sell the high of the triangle. I'm currently long JetBlue. I bought the dip around the flash crash low. I sat through a little bit of pain. It came back up. It came back down. I think I'm up like about $1.60 in terms of point wise on this. The 100 MA here was where it kind of collapsed below and has been the resistance. So as long as it holds over the hundo, I will be long. Anything below there, this is a longer term trend line. It's been unsustainable below there. So as long as the 100 holds, I'll be long. If it breaks, I will not be much longer. Smith & Wesson, not one I cover that often, but we're roughly around the 200 MA. This was a look above and fail double top. This is the trend line, and it's the hold. So row long against this trend line. It's also with this reference low, the 24s. If you lose that, just GTF the O. So right or right out, in my view, against the trend. Below is a get out. Walmart. So this came down quite hard. It rallied up to about a 50% fib, a little bit over, and it's pulling back. So if this were to get down to like this 50, like the 50%, so it took back 50% of the down move. If it takes back about 50%, somewhere between the 65 and the 63, that's the gap fill, and the 61.8. I don't think it's going to quite get this, but I do think it could get these lows here around the 64s. So I'd be somewhere interested in kind of BTD around the 64 or 65 level, somewhere on the around side of the 50% fib of the recovery. So I'd be interested in selling out of the money puts, probably 63, which is the 61.8, and below. Because you can see that area here, these lows, 62.32, 62.72, this area has been good support. So if this, my guess is this is going to bounce up to the 200 and maybe roll back over, but I would be interested in selling out of the money puts if it continues to go lower down there. Anyway, that's my story. I'm sticking to it. You have my levels. You have my thoughts on these stocks. If you're not following me on Twitter, my handle is @JustinPulitzer. Please leave some comments. If you liked the video, hit the thumbs up. And we'll have a good week, hopefully. And I will be looking to do some Periscope either on Wednesday or Thursday this week. Cheers.